Good evening and welcome to Joy Root Daily News. I'm Hannah from the Sales Department and I'm here to update the latest news for you. President Joe Biden imposed sweeping tariff hikes Tuesday on electric vehicles, semiconductors, and other goods imported from China, countering what the White House calls unfair trade practices by China that it says help put the U.S. industries at a disadvantage. The Biden administration has accused China of flooding the global markets with goods at artificially low prices, giving Chinese competitors an unfair advantage against their U.S. counterparts. White House officials say the tariff hikes are designed to create a level playing field for the U.S. manufacturing in clean energy and microchips, areas the Biden administration has targeted with the major government investments to try to catch up with China. Other goods from China slapped with higher tariffs include solar cells, battery materials, cranes used at port, and certain medical supplies, as well as steel and aluminum imported from China. Stainless steel markets in China and Taiwan recently faced low market demand. In China, despite significant fluctuations earlier this year, prices have mostly stabilized since April, hovering around last year's levels. Conversely, the Taiwan market has seen the steel price rise steadily for 5 consecutive months, driven by increased costs and tight inventory. China's stainless steel market has witnessed fluctuating trends since the May 1st holiday, with steel mill stance influencing market dynamics. Additionally, global nickel prices, including LME nickel and Chinese nickel pig iron, have remained elevated since April, further impacting stainless steel costs. Industry insiders attribute the steel mill's reluctance to slash prices to high production costs, particularly amid tense ferronickel supply. Despite market uncertainties, industry experts anticipate a potential upward trajectory for stainless steel prices, largely contingent on market sentiment and pricing attitudes. According to Asian media, the ongoing shortage of nickel ore in Indonesia is likely to continue in May. The allocation of mining licenses continues to be delayed and has forced several nickel smelters to curtail operations or suspend them altogether. Even though some smelters have now officially completed their maintenance work and resumed operations, output remained well below expectations due to the low availability of raw materials. Demand for ferrochrome was significantly stronger than expected in April. Demand from the stainless steel sector in particular came earlier than manufacturers had expected and appears to be continuing. According to media reports, bids for ferrochrome from stainless steel manufacturers were significantly higher than the expected price. Canada's mining industry is pushing for a carve-out to federal government proposed increase to capital gains taxes, warning the hike will make it harder for junior miners to raise money to find new mineral deposits. Finance Minister Christian Freeland's health budget includes a measure to raise the capital gains tax inclusion rate to 2/3 from 1/2. It applies to all gains made by corporations and trusts and to individual taxpayers on gain over $250,000 in a year. For many investors, the tax hike would significantly reduce the value of a measure called the Mineral Exploration Tax Credit, or METC, which is designed to help companies raise money to explore for critical minerals like copper, nickel, lithium, according to the Mining Association of Canada. The copper rally in Chicago, USA, has also outpaced Shanghai. The most traded front-month copper contract on the Shanghai Future Exchange has gained 15% this year. Some are looking for ways to re-export copper stocks out of China to capture some arbitrage gains. Junzheng Group has announced the addition of a new series of stainless steel vessels to its fleet renewal program at a domestic shipyard. According to a regulatory filing, Junzheng Group shipping subsidiaries SC International, based in Dubai, and Z Logistics Holding in Hong Kong have placed an order for up to 10 ships at Wujiang Shipbuilding. The agreement with the CSSC affiliated yard includes 5 confirmed orders and options for an additional 5 vessels, each within a capacity of 25,900 deadweight tons, amounting to approximately $451 million. Deliveries are scheduled between 2026 and 2028. Junzheng Group gained prominence as China's largest chemical tanker operator following its acquisition of Sinochem's fleet in 2019. Its subsidiary Shanghai Junzheng Shipping currently manages a fleet of about 80 chemical tankers, ranging from 3,000 deadweight tons to 40,000 deadweight tons. The EU failure to classify scrap as a critical raw material is baffling, given the EU scrap surplus will likely soon turn to a deficit amid steelmakers' EAF transformation. However, the list is subjected to revision and could soon see scrap added, concluded a panel at this week's European Economic Congress in Katowice, Poland. Scrap was not made a CRM solely because the EU is a net scrap exporter, but steelmakers are already looking ahead. Thanks for choosing us to stay informed. Goodbye and have a good rest of the day.